This is Ethical and Professional Standards, and this is the reading on the GIPS standards. I want to leave this slide up here for just a few seconds and remind you about the code of ethics and the standards of professional conduct. Remember that the CFA Institute uses words like professionalism and ethical behavior and integrity and investment analysis. I'll throw some other words on top of there, like honesty and hard work. And so the idea behind these global investment performance standards is to put forth a set of standards that's consistent with the code and the standards of professional conduct. In other words, if members and candidates are required to behave in an ethical manner, then of course they ought to be required to present their performance in an ethical manner. All right, a GIPS introduction. The main goal is to provide for full and fair disclosure of investment performance that is consistent with the entire code of ethics and all of the standards. The formation goes all the way back to 1995. And those of you who have a little bit of history in the CFA Institute will know that back in 95, it was called the Association for Investment Management and Research. And those AIMER standards were called Performance Presentation Standards. And it's interesting, they announced this in 1995, gave some guidelines and said, hey, we're going to warn you that by the end of 1999, we're going to start publishing these standards so that that members and candidates can then adhere to them by the end of the century. Now, since then, these GIPS have gone several rounds of extensive review. The most recent was in 2010. So they review emerging issues and try to be up to date so that all the provisions are current. Lots of countries have adopted the GIPS standards. 5 key objectives. Now remember, the big picture objective is to be consistent with the code and the standards, but let's be more specific here. 5 key objectives. Establish best practices for presenting performance. I mean, that makes perfect sense, especially when considering one of those standards was duties to clients and prospective clients. And so it's only fair that as an advisor or a money manager that we're required to ethically and accurately report what we've done. I mean, it's always tempting for us to identify our areas of strength and say things like, hey, I'm really, really good in this area, and even though I stink in that area, I'm not going to report the areas in which I stink. Of course, these GIPS try to prevent that. Worldwide acceptance and adherence to a single calculation. It doesn't make any sense if some members report average returns, some members report geometric returns, some members report holding period returns, and some members report some kind of made-up returns. All right, wide acceptance can only occur if there are single calculations. Accuracy and consistent investment performance data, that's important. The promotion of that. Healthy competition, of course. Members are going to compete against each other, and it's only fair that we're playing on the same court. I love to give sports analogies. Of course, when 24 professional golfers meet in the Ryder Cup, they play the same golf course. And the 5th one is interesting, to promote this culture of self-regulation. The CFA Institute is very proud to say that it self-regulates and that its members adheres to these self-regulations. All right, some key features. Ensure fair representation and full disclosure. That makes perfect sense. One thing that's interesting is that the CFA Institute provides some minimum requirements for the GIPS standards, but lots of members work for firms that have composites or portfolios or sets of portfolios that are fairly complex. And so the CFA Institute also provides some outline recommendations to handle those different complexities. So sometimes, maybe even oftentimes, it's not enough to follow just the minimum requirements, but members must follow some more strict requirements, which is consistent with what we learned back in the code and all the standards. All portfolios in a composite must be included. You can't pick the best ones. You can't ignore the worst performing ones. And of course, the integrity of the performance measures go back to the integrity of the data. CFA Institute is very clear on what constitutes good input versus poor input. And then whenever this institute makes some adjustments, then firms must comply with those updates or clarifications. Let's talk about the definition of a firm. This is important. To be in compliance, an entity must state how it defines itself as a firm. For example, I could just say, hey, I'm Jim. I manage a couple of portfolios. This is what I do. That's not quite enough. The firm must be defined as an investment firm or a subsidiary or a division. Total firm assets must be the aggregate of the fair value of all discretionary and non-discretionary assets. So remember, what's important here is that we're talking about the discretionary assets under management, in which the portfolio manager, the member, has the discretion to go in and buy and sell and change the composition of the portfolio. If there is a sub-advisor, that performance must be included. Now, what would that first slide or second slide say? We're up to in the 30 countries that have adopted or are aware of these standards. So there has to be a local sponsoring organization. Encourages countries without performance standards to adopt GIPS as the local standards and then translate them. Here's a good example of the definition of the firm. Here's an asset management firm that describes itself as an independent global asset manager with a deep-rooted local presence across Europe and Latin America. And then there are a couple paragraphs about what countries or how many countries and total assets. And notice in that third paragraph, 735 professionals, 212 of whom are investment professionals with an average of more than 10 years experience. Now, I would guess that some of those 212 hold the CFA charter, but notice that Santander doesn't say, hey, we've got these CFAs who are smarter than everybody else. So remember, the CFA Institute is proud of its brand name and requires its members to be humble about it. Next question that is addressed is how long do we have to worry about these performance standards? And so a minimum of 5 years of annual investment performance that is compliant must be presented. If less than 5 years, it must report data from the firm's inception date or the composite inception date. And then after 5 years, then they work up to a minimum of 10 years. And if you do an online search, you'll see that most of these firms publish that have been around for a long time. They publish 10 years. Now here's an important point here. You can link non-GIPS compliant performance to GIPS compliant performance only back towards before the year 2000. And see, there's a good lesson that you should know your history. If you know about that 1999 date that we talked about a few slides ago, then this makes perfect sense. Make sure you disclose it. Now, in order to claim compliance, firms must satisfy all of the requirements. Partial compliance is unacceptable. Firms are also encouraged to internally check for the compliance and whether there's a system of controls that encourages the ethical reporting of compliance. Independent third-party verification is always good. Now, a few slides ago, I commented that there was a nice update back in 2010. And so compliant presentations that began on or after January 1st of 2011 must be prepared in accordance with the 2010 edition, not the 1995 edition or the 2000 edition. Of course, the firms must comply with the most up-to-date edition. And GIPS serves as minimum standards. And so remember, if there are stricter laws in another country, then those local laws apply. And of course, if there's a conflict, then it must be disclosed. Here's an example of a report, Lord Abbett, which is a New Jersey firm. Their 10 years worth of performance. Notice the number of portfolios goes from 5 all the way back when we had that financial crisis in 2008 to its current level, 2017 being current, of 3 portfolios. And so what are they required to report? There's some total assets, their total firm assets. So note that the GIPS compliant represent just a relatively small portion of their total assets under management. Here's a good question. You guys paying attention? Why would the row for the internal dispersion not be reported? And this is an interesting answer. For firms that have 5 or fewer portfolios, the internal dispersion statistic is not required to be reported. It's an option. You can do it. Lord Abbett has decided not to. And there are some annual returns. Annual returns and then 3-year annualized returns, as well as standard deviations, and then some other good information. I encourage you to do a little search here and look for this Lord Abbett GIPS compliant performance and read the notes underneath it on the next page. They explain every one of those headings in the left column. Makes for fascinating reading. Now, there are 9 sections to GIPS. Let's quickly go through those 9 sections. Fundamentals of compliance. The definition of the firm is the basis for firm-wide acceptance of the standards. Compliant claiming firms must abide by the latest edition, and they must document in writing all the policies and procedures used in establishing compliance and maintaining that compliance. Input data. It's, of course, critical to have consistent data collection across all firms. A clear example is how do we determine that specific return for either the calendar year or the fiscal year? I mean, it makes perfect sense to have beginning of period market value and end of period market value. Of course, if this is, let's just take a simple example of a share of stock that began the year trading at $10 and ended the year trading at $10. Well, during the course of the year, it fell to $5. And so, one of the choices would be, okay, let's just pick the March 10th date when it was $5 and then the year-end date when it was $10. There's a 100% return. But clearly, that's not indicative of the performance. And so beginning and ending valuation dates must be consistent. Uniform calculation methodology across all firms. This is important. Actual trading expenses occurred during the period must be deducted, and there can be no deduction for estimated trading expenses. Now, a composite is constructed as an aggregate of multiple portfolios that are managed according to the same strategy or a specific mandate. And that return is the asset-weighted average of performance. And this is interesting because, suppose a firm has 10 high net worth clients, and they all say to the manager, we want to invest only in the 30 stocks in the Dow Jones Industrial Average. And so those client portfolio performances are going to be relatively similar, but the manager has the opportunity and the choice of which of those 30 to invest in for each specific client according to the mandate in the policy statement. Of course, disclosure is a big thing. Firms must disclose certain information regarding performance. Things like benchmarks and fees and composites descriptions. The firm must incorporate this information on input and the composites and the returns and any disclosures based on the requirements. That's why I asked you to go back and look at the Lord Abbott example and read the notes, because you'll see the necessary disclosures. This also, the GIPS applies to real estate. They must be valued, investments must be valued in accordance with the definition of fair value. Now, there's some interesting parts about real estate because, of course, an apartment complex doesn't really behave like a share of stock. And so there are some unique and interesting things about real estate valuation. The GIPS applies to all private equity investments, but not open-ended or evergreen funds. Any investment in a non-public company is considered private equity. And then wrap fees or SMAs, the separately managed accounts, have some interesting parts as well. And that concludes our readings on ethical and professional standards. Remember that this is very descriptive in nature. Practice the problems that the Institute publishes on its webpage. My advice is to buy the handbook or download the handbook and carry it around with you wherever you go. And whenever you have 5 or 10 minutes of downtime, just read it. This is what I did. Of course, when I went through the program, there were no such thing as reading it on your phone. But I had the physical handbook, and I carried it around wherever I went.